What I'm about to show you is the most important data release in the precious metals market this year, and I guarantee you will not see it covered on CNBC. You will not see it discussed on Bloomberg. You will not hear a single mainstream financial analyst explain what these numbers mean for your wealth. Because if they did, if they actually walked through the math, you would realize that the price of silver at current levels is not just undervalued. It is an anomaly. It is a market failure. It is a temporary condition that cannot persist because the physical reality no longer supports the paper price. And when that gap closes, and it will close, the repricing will be violent. The Silver Institute just released their official 2026 outlook. This is not some newsletter speculation. This is not YouTube analysis. This is the global authority on silver market data working with Metals Focus, one of the most respected precious metals research consultancies in the world. And what they are telling you in plain English, buried in their report, is that the silver market will be in deficit for the 6th consecutive year. Let me say that again so it sinks in. 6 years. 6 consecutive years where demand has exceeded supply. 6 years where the world has consumed more silver than it produced. 6 years where above-ground inventories have been drawn down to fill the gap. And the deficit for 2026 is projected at 67 million ounces. That is not a rounding error. That is a structural shortage of massive proportions, and it is happening right now in real time while the mainstream media tells you that silver is just another volatile commodity. Before we go any further, I need you to drop a comment and tell me where you are watching from today. Are you in the United States? Are you in Europe? Are you watching from India where physical silver demand has been exploding? Are you in China where they just had to suspend trading on a silver fund because the volatility got so extreme? Tell me where you are because Financial Crux is a global community, and I want to understand what you are seeing on the ground. Are the coin shops in your area running low on inventory? Are premiums elevated? Is there a disconnect between the paper price on your screen and the physical price at your local dealer? Drop your location in the comments and share what you are experiencing because this is how we build a real picture of what is happening in the market. Now, let me walk you through the numbers because this is where it gets absolutely insane. Total global silver supply in 2026 is forecast to reach 1.05 billion ounces. That sounds like a lot. That sounds like plenty of silver to go around. But here's the problem. Demand is higher. Total demand is exceeding supply by 67 million ounces. And this is not a one-time event. This has been happening every single year since 2021. The cumulative deficit over those 6 years is approaching 400 million ounces. 400 million ounces of silver that had to come from somewhere. And where did it come from? It came from above-ground inventories. It came from stockpiles that had been built up over decades. It came from vaults in London and New York and Zurich that are now running increasingly low. And at some point, those stockpiles run out. At some point, there is simply no more inventory to draw from. At some point, the price has to rise to a level where demand destruction occurs and supply increases become economically viable. We are approaching that point faster than most people realize. I need you to hit the like button right now. I know you have heard this before, but I am going to explain why it actually matters. YouTube's algorithm decides whether to show this video to 10,000 people or 10 million people based largely on engagement in the first hour. Every comment, every share tells the algorithm that this content is valuable, and YouTube does not want you seeing content that challenges the mainstream narrative about precious metals. They want you watching entertainment. They want you distracted. They want you consuming product advertisements from their sponsors. When you hit that like button, you are fighting back against that system. You are telling the algorithm that financial education matters. You are helping this information reach people who need to see it. So, do it right now. Hit the like button and help me break through the suppression. Let me tell you what happened in China last week because this is a preview of what is coming to every market. A silver fund listed in China had to suspend trading for an hour. For an entire hour, you could not buy or sell. And when trading resumed, the price fell by the maximum possible amount of 10%. This is not normal market behavior. This is a market in crisis. This is what happens when paper structures collide with physical constraints. The volatility we have seen over the past few weeks has been unprecedented, gold rising nearly 4% in a single day after falling by a similar amount the day before. Silver jumping 10% on Friday after crashing earlier in the week. Gold trading above $5,000 per ounce, then pulling back $400, then recovering. Silver hitting $80, dropping to $60, bouncing back above $80. These are not the movements of a stable, well-functioning market. These are the death throes of a paper pricing mechanism that can no longer contain the physical reality underneath. Let me give you the context that Bloomberg is not providing. Silver breached $100 per ounce for the first time in history in January 2026. That is a psychological level that market technicians have been watching for years, and when it broke, something important happened. The gold-to-silver ratio collapsed below 50. That has not happened since 2012. For context, the gold-to-silver ratio spent most of 2020 above 100. It spent years in the 70s and 80s, and now it is below 50 and trending lower. What this tells you is that silver is outperforming gold. Silver is catching a bid that goes beyond the general precious metals rally. Investors are recognizing that silver is the more undervalued of the two metals. They are recognizing that the supply constraints are more severe. They are recognizing that the industrial demand profile creates additional upside that gold does not have, and they are positioning accordingly. Now let me break down the demand picture because this is where the story gets really interesting. The Silver Institute is forecasting that physical investment demand will surge 20% in 2026 to 227 million ounces. That is a 3-year high. After 3 consecutive years of decline, Western physical investment is expected to recover dramatically. And why? Because silver's exceptional price performance and ongoing macroeconomic uncertainty are rekindling investor interest. People are waking up. They are seeing gold at $5,000, and they are looking for the next opportunity. They are seeing the headlines about currency debasement and institutional corruption, and they are looking for ways to protect their wealth. And they are finding silver, the poor man's gold, the metal that has all of the monetary properties of gold, at a fraction of the price. Physical investment in India is also expected to build on last year's substantial gains. Indian investors have always understood hard assets. They have always understood the value of holding real money outside the banking system, and they are accumulating aggressively at current prices. But here is what makes the situation even more acute. While investment demand is surging, industrial demand remains massive despite some thrifting at the margins. The Silver Institute is forecasting industrial fabrication of around 650 million ounces in 2026. That is down 2% from the prior year, but it is still an enormous amount of consumption. And the decline is largely due to substitution in the photovoltaic sector, where manufacturers are finding ways to use less silver per solar panel. But here's what the headline number misses. Several silver applications are benefiting from structural growth trends that are not going away. Data centers, artificial intelligence, electric vehicles, 5G infrastructure, defense applications. These sectors are consuming more silver every year, and that consumption is only going to accelerate. The AI boom alone is driving massive demand for server infrastructure that requires silver. Every data center being built to power the next generation of language models and machine learning systems needs silver, and there are not enough silver mines in the world to keep up. I want you to subscribe to this channel right now if you have not already. This is the kind of analysis you are not going to get anywhere else. The mainstream financial media does not break down Silver Institute reports and explain what they mean for your portfolio. They do not connect the dots between supply deficits and price implications. They do not tell you that 6 consecutive years of deficit means the stockpiles are draining and the day of reckoning is approaching. That is what Financial Crux is here for. Hit the subscribe button and turn on the notification bell so you get alerted every time I release new content. And join our WhatsApp community using the link in the description. That is where we discuss these developments in real time. That is where members share what they are seeing in their local markets. That is where you get the information before it becomes mainstream news. And follow us on X, formerly Twitter, for breaking updates throughout the day. The links are in the description. Do it now before you forget. Let me talk about the supply side because this is where the bulls have the upper hand. Total global silver supply is forecast to increase by only 1.5% in 2026 to 1.05 billion ounces. That sounds like growth, but it is barely keeping pace with the decline in above-ground inventories. Mine production is expected to increase by only 1% to 820 million ounces. And here is the critical point. Unlike gold, which is primarily mined for its own sake, silver is mostly produced as a byproduct of other mining operations. About 70% of silver supply comes from mines that are primarily producing copper, zinc, lead, or gold. This means silver production is not responsive to silver prices. If the price of silver doubles, you cannot just open new silver mines overnight. You have to wait for copper miners or zinc miners to expand their operations. And many of those base metal miners are facing challenges. Zinc and lead prices have been suppressed, creating downside risk to the sustainability of those operations. If lead and zinc mines start shutting down because they are uneconomic, silver supply takes a hit as a byproduct. The geographic distribution of production is also concerning. Mexico is the largest silver-producing country, and much of the expected growth is coming from primary silver mines there. But Mexico has political and regulatory risks that could disrupt production. Peru, another major producer, is actually expected to see lower production from some key operations. The gains in Canada and Morocco from newly commissioned projects will help, but they are not enough to dramatically shift the supply picture. And remember, we have been in deficit for 6 years. The cumulative drawdown of inventories is substantial. Every year we run a deficit, the buffer shrinks. Every year we consume more than we produce. The cushion gets thinner, and at some point there is no cushion left. Silver recycling is projected to rise by 7% in 2026, with volumes surpassing 200 million ounces for the first time since 2012. This is the market's attempt to find additional supply. When prices rise, people bring out their old silverware and jewelry and sell it for scrap. That recycled silver helps fill the gap. But here's the thing. Recycling is a lagging indicator. It responds to price. It does not drive price. And even with the surge in recycling, we are still in deficit. Even with every grandmother selling her silver tea set, we still cannot produce enough silver to meet demand. That tells you everything you need to know about the structural imbalance in this market. Let me address the volatility, because I know it has been shaking people out of their positions. Commerce Bank just released analysis noting that precious metal prices have been characterized by exceptionally high volatility in recent days. Gold rising 4% after falling 4%. Silver rising 10% after falling by similar amounts. Gold ETFs recording outflows of 20 tons last week, the strongest weekly outflow since October. This volatility is real and it is concerning for short-term traders. But I want you to understand what it actually means. The volatility is a feature, not a bug. The volatility is what happens when a paper market that has been suppressing prices for years starts to lose control. The volatility is what happens when physical demand collides with paper supply. The volatility is what happens when the London market is tight. When COMEX inventories are low, when China is suspending trading on silver funds because they cannot handle the order flow. Let me read you what Commerce Bank said about investor sentiment. Quote, "The sharp ups and downs in prices over the past week have clearly left their mark on investors." End quote. Yes, they have. But here is the question you need to ask yourself. Are you a short-term trader trying to catch every wiggle, or are you a long-term investor positioning for a structural revaluation? Because those are two very different games. The short-term traders are getting whipsawed. They are buying the rips and selling the dips. They are letting the volatility shake them out of positions that they should be holding. The long-term investors, the ones who understand the fundamental supply and demand picture, they are using every dip to accumulate. They understand that 6 consecutive years of deficit means prices are going higher over time. They understand that 67 million ounces of annual shortfall cannot be sustained indefinitely. They understand that when the physical market finally breaks the paper pricing mechanism, the move will be explosive. Now, I want to talk about something that is not getting enough attention, the physical tightness in London. The Silver Institute specifically mentions that physical liquidity in the London silver market may remain relatively tight. London is the center of the global silver trade. It is where the benchmark price is set. It is where major institutions trade physical metal, and it is tight. There is not enough physical silver available to meet demand at current prices. This is creating upward pressure on the price and forcing the market to draw down inventories that are already depleted. The Institute explicitly states that the global silver market will continue to rely on the release of bullion from above-ground inventories, adding pressure to an already tight physical market. They are telling you in plain English that the system is strained. They are telling you that inventories are being depleted. They are telling you that the current price is not sustainable given the supply and demand fundamentals. I want to ask you something directly because I think it is important for this community to reflect on these questions. What is your conviction level right now, after the volatility of the past few weeks, after watching prices spike and crash and spike again? Are you more convinced or less convinced about the precious metals thesis? Drop your answer in the comments. I read every single one, and I want to understand where the community is at mentally, because I will tell you where I am at. I am more convinced than ever. The volatility does not scare me. The volatility confirms that we are in a historic transition. Stable prices reflect stable fundamentals. Volatile prices reflect a market in flux. A market where the old equilibrium is breaking down and a new equilibrium has not yet been established. That is exactly what we are seeing. The paper pricing mechanism that has controlled silver for decades is losing its grip. The physical reality is asserting itself, and the price discovery process is messy and volatile because the transition is happening in real time. Let me give you the investment demand breakdown because this is encouraging. Global ETP holdings, which are the exchange-traded products that hold physical silver on behalf of investors, stand at an estimated 1.31 billion ounces. That is an enormous amount of silver held by investors who believe in the long-term thesis. And despite the volatility, despite the outflows from some ETFs during the sharp price swings, the overall holdings remain near historic highs. Silver ETFs recorded a weekly inflow of 700 tons recently. Yes, there were outflows on some individual days as volatility spiked, but the net flow was positive. Investors are accumulating. They are using the dips to add to positions. They understand that short-term volatility creates long-term opportunity. Now, let me connect all of this to the bigger picture because the fundamentals do not exist in a vacuum. The Silver Institute mentions several macro factors that are supporting precious metals prices. Elevated geopolitical tensions, concerns over the Federal Reserve's independence, persistent uncertainty surrounding U.S. policy. These are not temporary conditions. These are structural features of the current environment. The geopolitical situation is not calming down. It is intensifying. The concerns about the Fed's independence are not going away. If anything, they are getting more acute as the next leadership transition approaches. The policy uncertainty in the United States is not resolving. It is deepening with every new executive order and every new tariff threat. All of these factors support the case for hard assets. All of these factors drive capital out of paper and into physical wealth. Here is what the Silver Institute says about the outlook. Quote, "Looking ahead, the global economic and geopolitical environment is likely to remain supportive for precious metals prices in 2026. In addition, physical liquidity in the London silver market may remain relatively tight. Furthermore, a still supportive macroeconomic backdrop and forecasted strength in gold should help limit downside risks for the silver price, even though heightened price volatility will remain a feature for the foreseeable future." End quote. Read that carefully. They are telling you that the environment supports higher prices. They are telling you that physical supply is tight. They are telling you that gold strength will support silver. And they are warning you that volatility is going to continue. This is not a market for the faint of heart. This is a market for people who understand the fundamentals and have the conviction to hold through the turbulence. Let me talk about what is happening in jewelry and silverware demand, because this shows you how price-sensitive some parts of the market are. Jewelry demand is projected to fall over 9% in 2026 to 178 million ounces. That is the lowest level since 2020. Record high prices are curtailing consumption in most major markets, especially India. When silver is at $80 or $100 per ounce, fewer people buy silver jewelry as gifts or adornment. That demand gets destroyed by price. And this is actually healthy for the market because it shows that the price mechanism is working. Higher prices are rationing demand among discretionary uses. The silver that would have gone into jewelry is now available for industrial and investment uses where demand is less elastic. Silverware demand is expected to contract even more sharply, declining approximately 17% in 2026. Again, this is happening primarily in India, where silverware demand is highly price sensitive. When silver prices are low, Indian families buy silver plates and cups and decorative items as gifts. When prices are high, they buy less or switch to alternatives. This is normal economic behavior. This is the market adjusting to higher prices. And importantly, this demand destruction among discretionary uses is not enough to eliminate the deficit. Even with jewelry demand at multi-year lows and silverware demand collapsing, the market is still in a 67 million ounce deficit. That tells you how strong the investment and industrial demand components are. That tells you that the core demand for silver is robust and structural, not discretionary and price sensitive. China is the one exception to the jewelry demand decline. The Silver Institute notes that Chinese jewelry demand is anticipated to edge higher, supported by product innovation and the growing popularity of gold-plated silver jewelry. This is interesting because it shows Chinese consumers finding creative ways to continue buying silver despite higher prices. Gold-plated silver gives you the look of gold at a fraction of the cost. It is a way for consumers to participate in the precious metal story without paying full gold prices, and it is driving demand in the world's largest market for physical precious metals. Let me give you my framework for thinking about silver in 2026 because I think it helps to have a mental model. We are in the 6th year of a structural deficit. That means inventories have been drawn down for 6 consecutive years. The buffer between supply and demand is shrinking. At the same time, investment demand is surging as more people wake up to the monetary and inflation hedge properties of precious metals. Industrial demand remains robust despite thrifting, because structural growth drivers like AI and EVs and data centers are overwhelming the efficiency gains, and supply is constrained because silver is primarily a byproduct metal that cannot respond quickly to price signals. All of these factors point in the same direction: higher prices. The only question is timing and path, and the volatility we are experiencing is the market working through the transition from the old equilibrium to the new one. Before I close, I want to make sure you are connected to the Financial Crux community. This is not just about watching videos. This is about being part of a network of people who are paying attention, who are thinking critically, who are positioning themselves for what is coming. Join our WhatsApp community using the link in the description. That is where we share real-time information and discuss what is happening in markets around the world. Follow us on X, formerly Twitter, for breaking updates throughout the day. When major moves happen, I post there before I can make a video. You do not want to miss those alerts. The links are in the description. Do it now. The Silver Institute has given us the roadmap. 6th consecutive year of deficit, 67 million ounces short, physical tightness in London, investment demand surging 20%, above-ground inventories being depleted, and a macro environment that supports precious metals prices. This is not speculation. This is official data from the most authoritative source in the silver market. The question is not whether silver is going higher. The question is whether you are positioned to benefit when it does. I want to hear from you in the comments. What is your silver price target for the end of 2026? Do you think we test $100 again? Do you think we go higher? Do you think the volatility shakes out enough weak hands that we see a correction first? Tell me your outlook, because this community is smarter than any individual, and I learn from your perspectives every single day. The mainstream financial media is going to continue telling you that precious metals are volatile and risky and that you should stay in stocks and bonds. They are going to continue ignoring the supply deficit data. They are going to continue pretending that 6 consecutive years of inventory drawdowns means nothing. Do not fall for it. The data is clear. The fundamentals are supportive. The macro environment is bullish. The only volatility you need to fear is the volatility of missing the move entirely. This is Financial Crux. Thank you for watching. Hit that like button if you have not already. Subscribe and turn on notifications so you do not miss the next update. Join our WhatsApp community using the link in the description. Follow us on X for real-time alerts. Share this video with someone who needs to see the data, and I will see you in the next video with more analysis, more truth, and more information that the mainstream media does not want you to have. Protect your wealth.